Morning, everyone. Just waiting for people to join as it just takes some time to get everyone in from the waiting room. So bear with us just for a little while. Thanks for joining those that have so far. Okie dokie. Well, people will continue to join, no doubt, as we get started. Thank you to those that have joined us. I'm going to share my screen so that we can get going and kick off with our inheritance tax webinar. So hopefully now you'll be able to see the slides. Jamie's going to give me a thumbs up if that has happened. Excellent. Good. Right, so yes, welcome to Magenta's Inheritance Tax webinar today. Thanks for joining us. And of course, for those that might be listening back, because we're recording it today and we'll be making sure people can listen back to it. Thanks for taking the time out of your day to listen to us talk. As many of you may know, but I'm going to introduce myself. I'm Gretchen, MD and financial planner at Magenta. And today I'm joined by Jamie Flook, financial planner here also at Magenta, and Siobhan Griffin, who's Director of Regional Business Developments at Time Investments today. So thank you, especially to Siobhan, for joining us today.
Thank you.
This webinar is going to cover the basic about inheritance tax and some simple legal tax mitigation actions you can take in your financial planning to reduce some of the inheritance tax burden on your estate. And Siobhan from Time Investments will also be sharing with you the key features and advantages that an investment that qualifies for business relief can provide to you. I'd like to make it clear that we've asked Siobhan here today to share her expertise in regards to business relief investments and how they work, so that we can ensure that you are well informed about all the options in connection to tax efficient investments when trying to mitigate IHT. However, it doesn't mean that any of the options we discussed today around estate planning and the use of business relief investments are suitable for everyone. And you should contact us directly if you'd like to discuss your own situation and personal circumstances. Also, any tax assumptions, of course, that we talk about today are based on our understanding of HMRC's guidance and practice at this point today, and of course might be subject to change in the future. So that's kind of my, compliance a blurb that I have to say. We've chosen this topic today because in our feedback from clients, inheritance tax is, high priority and that you wanted to know more. So that's why we're running today. Obviously, if there's any other topics you'd like us to cover in the future, then let us know. So moving on, let's get on with it. Quickly, an overview, I guess, of what is inheritance tax. We know that many of you know the basics already, but as a reminder, inheritance tax, or IHT, which we tend to shorten it to, and it's commonly known as, is a tax that's levied on your estate after death. Your estate is made up of your property, cash, investments, valuables, etc. All those things that create your net worth when we speak to you in our planning meetings. After death, your executors have to apply for probate. And then after this, the value of your estate is reported to HMRC, to Revenue and Customs, using a form IHT 400 usually. And this has to be done within 12 months of death. So who pays inheritance tax? Well, inheritance tax is payable by individuals or couples, but of course, really by your estate, because you're likely to have gone by then. Often, if you are a couple and the first one of you dies, you generally tend to leave everything to one another, to the remaining partner. So IHT might not be applicable on first death, but instead might be calculated on second death. Of course, this depends on a multitude of things. It's usually impacted by the way that you've written your will, whether you've maybe left specific bequeaths to other people, whether there's been previous gifts that need to be considered. And particularly when not everything passes to the other spouse, that might be where there needs to be a calculation on first death. But as I say, typically what we tend to see is that big calculation being done on second death. The IHT then is calculated, and it has to be paid, as I say, by your estate and your executors rather than yourself, because you're no longer going to be here. So they're responsible for paying that tax. So how much to pay? Well, I thought we'd run through the allowances. Everyone gets some allowances. Some of them we find really easy to understand. Others of them are a little bit more complicated. So everybody gets an amount that our estate can be worth before we pay any IHT, or our estate is liable to IHT. So let's run through these. Everyone gets 325,000, which is the IHT free allowance. It's known as the nil rate band, or as we've shortened it here to NRB. And for a couple then, combined, that would be 650,000. If you have children and linear descendants and intend to leave your estate, including a home, a house, to them, you can benefit from the additional 175,000, which is called the residence nil rate band, or RNRB. And for a couple then, combined again, that would be 350,000. So with the doubling of the nil rate band for two of you and the doubling of the residence nil rate band, I'm going to call it because I get confused with those letters. That means that 1 million of total allowance generally for a couple is the amount that we're looking at. So it does mean that in simple terms, those that are married with children or grandchildren could leave an estate up to 1 million. You know, if you don't have children or linear descendants, you can't use that residence nil rate band. So you would have a reduced allowance of just the 325,000 or 650 between you. As well as only being available to people who have children and linear descendants to leave their home to, it also gets taken away if the estate is very large. So that residence nil rate band is going to gradually reduce if your estate is worth over £2 million. And that applies even if your home is left to direct descendants, it's still going to be reduced. It's reduced by £1 for every two that the estate is worth over 2 million. And effectively, it means that it's lost by the time you get to about 2.35 million. Another key point just about that residence nil rate band, which we see people slip up a little bit with sometimes, is that if the home is worth less than that residence nil rate band, you can't then use the remaining amount of that residence nil rate band to apply to other assets. It only can be used for the home. So for example, if as a couple, your own home was worth £300,000, despite the fact that the combined residence nil rate band is 350, you'll only be limited to 300,000. You would be limited to 300,000, and the extra 50 is ultimately just lost. You can't use that for other assets. So hopefully that's explained those kind of allowances a little bit. So what about the tax rate? Well, the standard rate of IHT for estates valued over the before mentioned allowances is 40%. A reduced rate of IHT can apply where you choose to leave 10% or more of your net estate, which is basically after deducting the exemptions, relief, and any other nil rate bands that we're looking at, is left to charity. So if you leave 10% of your net estate to charity, then you can reduce the inheritance tax rate from 40% to 36%. I would just caveat that it's really important that this is written in a will correctly, and that the instructions you give are checked by a solicitor to make sure that the the way that it's written leaves it in the correct way. I've seen some situations where a bequest has been put before the charity contribution, and then sometimes that can mean that actually it's not the net estate, and it can get into nitty-gritty of legislation. So just make sure, if you want to benefit from this, you want to leave your 10% to charity, then that you've done it formally with a solicitor who knows how to structure your will properly. And of course, if you do leave any gifts to charity, they receive them 100% without any deduction of inheritance tax. So this leads us nicely onto the next section, in which Jamie's going to talk a little bit about the basic inheritance tax planning you can do, and some strategies that you could think about. So I'm going to pass over to Jamie now. Thank you.
Yeah. Thanks, Gretchen. So you've explained a little bit there about what the rules, limits, allowances and the basics are. In this next part, I'm going to explain what you can do to best prepare yourself and to make things as smooth as possible for you and for your loved ones as well. So some of the basic planning points there then that we always talk about with our clients when we talk about inheritance tax, and the most basic of them is putting in place a will. And if you're in a couple, you'll need a will each, of course, because it only applies to you as an individual. So you ideally need to have a will in place so that it's clear who you want your possessions to go to. And if you don't, then it follows what's called the laws of intestacy. So it's a very set route of where all of your assets will go depending on your family situation. It's far, far better to keep that control for yourself. And even if it's the case that you want things to go completely to your spouse, if it's you on first death that goes, then you want to make sure that's written down in the form of a will. The next point is letter of wishes. So whilst a will is legally binding, a letter of wishes is not, but it is something that quite often people want to put in place to accompany their will. So it provides an opportunity to give instructions on how you would like things done following your death. So for instance, it could be not only would you want some assets to go to a family member, but it's actually how do you want that to be done, you know, in what form you want that to be done. And equally, if you want to set up a trust on death, which some people do in some certain circumstances, then a letter of wishes can be used to explain exactly what you'd want that trust to do and how you'd want it to be run. So a letter of wishes isn't mandatory, isn't compulsory, but in some situations it can be quite useful to have that. The next point is lasting powers of attorney. So this doesn't directly relate to inheritance tax planning, but generally it's something that we recommend you get done at a similar time to thinking about inheritance tax and wills, because quite often they tie in together. So lasting powers of attorney are designed to give legal authority for a person or group of people to act on your behalf should you lose mental capacity and be unable to make decisions for yourself. So on there, we've put ×2, and the reason we've done that is because there are two different types. There's property and financial affairs, and the other is the health and welfare lasting powers of attorney. So they do different things. Property and affairs covers your finances and how to pay, for example, it could include how to pay for your care should it be required. The health and welfare lasting power of attorney covers, for example, the type of medical treatment that you might be comfortable receiving and how this would be administered. It's much more to do with your health. And so thinking about these two things, so will and lasting powers of attorney, and how they're kind of set up in similar ways. For your will, you would always need at least one named executor. And for lasting powers of attorney, you need at least one, ideally two attorneys. In each case, we recommend asking the person or people that you wish to do this and to make them aware of what it actually involves, what their responsibilities will be, because in some situations you can be asking quite a lot, so they need to be prepared for that. We asked at Magenta, we asked that any wills or powers of attorney that you put in place, that you send us a copy, so that as and when relevant, we know who's involved and we can help expedite anything that you need doing at that point. We've found in our experience it makes things a lot easier if that's the case. And then there's one other thing that, talking of what we do at Magenta, we provide a Magenta manual. This is something that we've put in place quite a few years ago now, but there's been subsequent releases of it where we've thought to add things into it. And so this is a free document from us. It comes blank, but with guidelines for you to put information about your life in, such as your family details, contact details of family and friends, where you keep important things like documents, medical conditions you might have, important professional contacts like us, for instance, you want to be aware of, and any last wishes that you might have. It's really designed as a document so that if you become mentally incapacitated in the future, or as and when you've passed away, it's whoever's going to pick that up on your behalf, whether it's your executor, whether it's an attorney, you're making life as simple as possible for them so they know exactly what to do, and they don't need to go hunting around for these different things that you need to let them know. And so this we can provide as a Word document, in the paper, in post, if you want, prefer old-fashioned pen and paper method, or as an editable PDF document. So if you want a copy of this, just let us know and we can send that across to you. So that's a little bit about the kind of the basics, if you like. A lot of that is more administrative. This section, I'm just going to quickly focus on some of the more financial planning aspects of what you can do to potentially reduce your inheritance tax liability. And so I preface this by saying that not everybody wants to do this. People might want to retain their money for lots and lots of different reasons, whether it's to be able to control what happens with that money, or whether it's simply because their own beliefs say that they're comfortable paying inheritance tax and don't want to mitigate it. But we know from experience that a good percentage of our clients do want to understand ways in which they can mitigate inheritance tax and potentially help family out sooner if they can afford to do so. So here are a few of those. So the first one there, gifting from regular income. So this we find is quite an underutilized exemption and quite a good one if you can use it. So it only works if your income comfortably exceeds your expenditure. You can gift away the difference to whoever you like, and this money that you gift away is immediately outside of your estate. Ideally, there needs to be a regularity of gifting, a kind of pattern that you can evidence, or executors can evidence in the future if it was ever required, such as setting up a direct debit monthly, for instance, to gift to family members if you're able to do so. The next one there is gifting within allowances. So I won't go through all the different allowances because there are lots in lots of different situations, but generally speaking, there are various allowances that you're allowed to give away certain amounts of money, roughly speaking up to a couple of £1,000s a year, for things like weddings and general gifts to family members or Christmas presents, for instance. These smaller gifts are immediately outside of your estate once they're gifted, again, as long as they stay within allowances. So really large, meaningful gifts will not be allowed under those exemptions. And those come under a separate category, so what we would term as larger gifts. So if you're thinking, and when we talk about this, we're talking about multiple thousands of pounds, or whether it's just cash, or whether it's potentially gifting a property or a share of a property, or even some investments that you might own, or whatever it may be, part of a business. These types of gifts, you'll need to live for 7 years after making the gift for it to be completely outside of your estate. And the reason I say completely outside of your estate is because there are some rules that mean that after a few years after you make a gift, then a little bit of the gift is outside of your estate. But really, when we talk about this, the 7-year time frame is important. So were you to die within 7 years after making a large gift, the vast majority, if not all of it, will be treated as if it was never gifted, and it will still be included in your estate. So there's always that timing issue to consider, is as and when you ever want to do this. And the last one noted there, and it's the most simple by a mile, is spend it. So if you're finding that you do have additional money left over, and there are things that you want to do, or trips you want to go on, or things you like to spend on doing on the house, well, great. As long as you can afford to do so, and a really good way of knowing whether you can do so is, of course, when we do your planning meetings and we look at your cash flow forecast and look at the direction your money's going in now and in the future, If you can afford to spend it and you can see that you're going to have an inheritance tax problem in the future, then it's a really effective way of cutting down on your inheritance tax liability. And then just a couple more from me, or actually only one more before I hand over to Siobhan. So it's talking about trusts. Now, trusts are a way of being able to gift money, potentially typically for future generations. You can put cash, you can put other assets such as property or investments into trust. There are lots and lots of things that can go into trust. And a pretty typical example would be to put in some money that you've got into investments for grandchildren for university costs. So say you've got some grandchildren that are quite young and you've got quite a long time frame, say 15 plus years before they need to go to university, and you'd like to help out with their costs, then you can do so. And of course, a really good way of doing that is investing, because you'd ideally want that money to try and work hard in that time that it's in the trust before it can be used. So you, your children, or anyone else who is willing to do it would then act as a trustee if you set up a trust. And the trustees manage the assets of the trust, and indeed quite often they'll get help from a financial planner like us to help them manage the funds that are in trust. And then in the future, when that money is needed, perhaps when those grandchildren have gone to university, then you would sell the assets that are required at that time, and as trustees make sure that money is available to the beneficiaries, your grandchildren, to use as and when it's needed. The great thing about a trust is that you, as the person who puts the money in, or as the trustees, get a lot of control about when the people you intend to benefit actually get the money out. We know that with some investments you can set up, or some things you can put in place for grandchildren, they get it at 18. Well, quite a lot of the time, those people aren't quite ready to have that money at 18, and it might be that it'd be much better off later on if it was for something else. So trusts are an option, and they can work really well. But at Magenta, we generally only usually explore a trust as an option once other options have been considered first. And the reason for that is that there's a cost to setting up a trust and to maintain it quite often, as well as the fact that quite often you'll need potential legal advice as to actually how to set it up, particularly if it's a complex trust. So they can work well, but equally, we find that for a lot of our clients, quite often they don't need the complexity that comes with them. It's only in certain circumstances that it might actually be worth that complexity. So that's just a few ways in which you can make things as easy as possible administratively for your beneficiaries, through your attorneys and your executors, and also some ways that you can look at potentially mitigating and reducing your inheritance tax liability. Now, I'm going to hand over to Siobhan, our guest speaker from Time, to tell you more about the other option that's noted there, which is business relief investments. So, Siobhan, welcome.
Thank you very much, Gretchen and Jamie, for inviting me to join you. It's a real pleasure to be here. My name is Siobhan Griffin. I am the Director of Regional Business Development at Time Investments. And I must compliment you both on your forward thinking in terms of asking for feedback from clients and focusing on this really, really important topic. And it's a pleasure to be able to talk about options for clients in this space. So Time Investments, just by way of an introduction, we're a specialist investment manager. We predominantly invest across a variety of sectors, including infrastructure, real estate, renewable energy, and the lending sectors. We are one of the largest providers of business relief services in the UK, with over £1 billion in assets. And, we are one of the well-regarded tax-efficient investment houses. So I will talk very briefly this morning about business relief. Probably won't be able to do the entire planning scenario justice in 10 minutes, but there's a lot that we can cover. So I'm going to break it down into the what, the how, and the why. Just to be clear, although at Time we are regulated by the the FCA, I'm not here to provide advice or assess the suitability of these investment strategies for you, but clearly you can consult with your advisors for that matter. So let's move on to the what. So if I could go to the next slide. Business relief. So business relief, if you've never heard about it, there's plenty you can find out online and you can Google, but this is a statutory relief that's been in place since 1976. So it's been around for nearly half a century. So it's not some new idea, albeit that I've been in the tax efficient investing world for about 15 years. And I must say that certainly in the course of the last 5 to 10 years, it's become very much more a mainstream conversation that people are having. And I think that's referencing the fact that so many more people are impacted by inheritance tax than ever before. And we certainly know that the inheritance tax take is at peak levels, having been £7.1 billion in the last tax year. So business relief as a concept was introduced in 1976 by the government at the time, and it has been in place since that time, and it has been actually improved in terms of the conditions that are on offer. So when first introduced, it was introduced at a level of 30%. The terms increased to improve the relief for investors to 50% in the 1980s, and beyond that it's increased to 100%, and I will come to explain that in a moment. But why is it important? It was implemented as a means of ensuring that companies did not have to be sold or broken up to pay death duties at that time. The concept behind that being that that wasn't very good business sense. It wasn't very good for UK PLC. And of course, the family business sector in the UK employs over 14 million people today, and it's growing, and it's incredibly important. So in 1976, the government implemented a rule whereby they said, if you owned a trading business, that trading business would not be subject to inheritance tax. That relief has been improved and extended in the 1990s to ensure that private investors who wish to invest as minority shareholders in trading companies can also benefit from that inheritance tax relief. So in terms of my slides, one of the key criteria that is, I suppose, beneficial to clients in this space is the 2-year term that relates to business relief qualifying shares. So if you own business relief qualifying shares, you can be 100% free from inheritance tax once those shares have been held for a 2-year period. Now, there are some qualifying criteria. I don't propose to go into that now because it's too much for this particular session, but we could certainly do that at a later point. Jamie and Gretchen have talked about inheritance tax planning and spousal transfer, and the fact that if you are a husband and wife, often assets pass straight from one spouse to a surviving spouse. The benefit with something like business relief is even if the investment is made by one partner and that partner passes away, but passes away before they've achieved business relief after 2 years, the business relief qualifying clock can transfer to the surviving spouse. So it only requires that out of a couple, that one of that couple survived for 2 years in order for the inheritance tax relief to be feasible. And in terms of access, I think this is one of the driving characteristics of business relief. People do get concerned at times about the need to be able to access capital and have control. Gifting is a great strategy for some, but if you're concerned about long-term health care, long-term care costs, etc., and want to be able to access capital, the fact that you can hold business relief qualifying shares as an investment in your own name without gifting or without transferring into trust means that you can access that investment should you wish to do so. So there's a number of features there to be aware of. Move on now. Thank you. So there are different ways in which you can access business relief as an investor. The first of which, and maybe some of you already own trading businesses or have owned trading businesses. So the first and most simple way is, if you are a business owner and your business is wholly or mainly trading, then that business qualifies for relief. Or if you wanted to invest in a business which is wholly or mainly trading, again, it is likely that that investment or that capital would be free of IHT. But there are other ways in which you can access business relief as well. And I'll just go through the other three. The first of which is to invest in an AIM portfolio of business relief qualifying shares. Now, not all shares on the AIM market qualify for business relief, so there are numerous providers such as Time and others who bespoke particularly specific business relief qualifying portfolios on the AIM market so that investors can access that. The second way in which you can access business relief is through an asset-backed business relief service. And this is where you become a minority shareholder in an unlisted company, and that unlisted company undertakes a range of trades in the UK. And I'll come to some examples of what that might look like in a moment. But largely speaking, that gives access to a diverse portfolio of trading businesses, which again, once you've held those shares in that investment for 2 years, that investment would not be subject to inheritance tax. And the third way of accessing business relief through an investment is through the enterprise investment scheme. Now, broadly speaking, again, your advisors would talk to you in more detail. These are not necessarily suitable for all clients, and they are higher risk investments, and to ensure that you are able to access these, you actually have the benefit of various reliefs such as income tax relief or CGT deferral alongside the business relief. So I think we can move on to the next slide. This is just to show that since 2016, and we could take this picture all the way back to the inception of business relief, there has been a continuing increase in terms of the value of investments made in these sectors. So certainly it's the case that inheritance tax liabilities are growing across the UK, and also associated with that, there are more and more people coming to the business relief market in order to invest in these sort of strategies. Okay, we can move on. So let's look at the why, and I have touched a little bit on this, so we can move to the next slide. These are the key 4 reasons when we talk to advisors or we talk to investors about why they access business relief investments, be that through asset-backed strategies or AIM services. It's these 4 criteria that are the key drivers. So the retention of access is a key criteria. So being able to access the funds should one need them. Now, in the majority of cases, most clients don't need to access them. They will often make the investment and it is a buy and hold strategy that they retain until death. But to the extent that they felt they needed access, then access is available, and you don't have to go through trustees or have other restrictions in that regard. The fact that the investments are held in their own name means that they can control that investment, and as we said before, the fact that business relief can be effective within 2 years rather than in the scenario of gifting and trusts where you have a 7-year clock. Often people will tend to come to these strategies when they are slightly later in life, or where they feel that other options might not be as effective for them. And again, of course, the point about avoiding complex structures that they may not be as interested in.
Oh, sorry, I missed that.
That's all right, don't worry.
Right, next.
So here's some examples of asset-backed investment strategies. So at Time, we run a portfolio whereby our minority shareholders in something called Elm Trading get access to a range of alternative investments which do not perform in the same way as the equity markets or the bond markets. So for very many of our clients, not only is this a strategy for inheritance tax planning, but it's also potentially an opportunity to diversify their investments into other sectors which are of interest to them and which perform in a non-correlated way to the way the remainder of their investment portfolios behave. Some of the benefits of investing in these spaces, so for example, clean energy, in the majority we tend to look at wind and solar power. We have secured property lending, we have operational real estate finance, we have forestry, we have self-storage. These are all really interesting business trades that as a private retail client, it would ordinarily be quite difficult to get access to. So it's a diverse portfolio and it's giving rise to a different way of investing and uncorrelated returns. There is also the happy side consequence of ESG, or social and positive impact. So to the extent that we're investing in wind and solar and hydropower in the UK, and indeed even sustainable forestry, there are very many sort of social and positive impacts to be derived from that. And many of our clients, enjoy talking about the fact that they are supporting those industries. We talked about the fact that you've got the asset-backed businesses that allow you to access business relief, but there's also the AIM market, which again, I'm sure if you're active investors already, you will know of the AIM market. These are some of the reasons that people invest in the AIM market. Often the profile of our AIM investors is quite different to that of asset-backed. They're looking for quite different styles of return. AIM can be quite a volatile market, so it can go up in the longer term, but it can also go down. So one has to have a tolerance for loss and an attitude to risk, or a capacity for loss in that particular market. But the majority of our clients who invest in AIM will tend to have a much longer term view of that investment, and it may even be an investment that will be inherited by beneficiaries in the future. So they're targeting longer term growth. They're investing potentially in new and emerging sectors in the UK. They're supporting British businesses, and there's a range of other attractive elements as well relating to investing on the AIM market. We'll move on to the next slide now. Thank you. So let's just look at one example of an actual practical, very simple, how does business relief work? We've got an example here of Vera. Vera's estate is valued at 1 million, which is made up of an £800,000 property that she lives in. And she has additionally £200,000 of investments and other assets. So she is a single lady. So going back to Gretchen's earlier example around residence nil rate band and nil rate bands, the nil rate band that this individual will have is £325,000. So anything above £325,000, so 675,000, will be subject to a 40% inheritance tax charge. So she has a motivation to mitigate that in some way. In this scenario, she's been advised by her advisor to invest from her £200,000 of cash. She's going to put £50,000 into a business relief planning service. If she invests and she holds shares in that service and survives for a 2-year period, they will be deemed to be business relief qualifying. So on that portion of her investment, at £50,000, she will not be subject to a 40% inheritance tax charge. So that investment effectively falls out of the scope of IHT after 2 years, giving her a £20,000 IHT saving. That's just a simple example of taking cash from an investment portfolio and repurposing it, putting it into business relief and seeing the outcome that it can have. There are no maximum amounts that you can invest, but obviously it will depend on a client's attitude to risk and suitability, and you would be advised by your advisors on that matter. So that's just an example of how it works. And in terms of time, just a very brief word about us. We've been working with Magenta now for very many years. We've got about 4.5 billion under management. We are one of the largest operators in this space, with a 27-year track record of delivering business relief qualifying services to our clients. And again, if you'd like any further information, or you'd like to speak to us about what we do and in more detail, we will be very happy to support you with that. Thank you.
Thanks, Siobhan, and thanks to everyone for listening. We do have a few minutes for questions. If anyone's got anything, you can put it in the Q&A at the bottom. I'll be able to see that and then can ask the question. I guess I just thought quickly though, before, just to give a bit of time to see if anyone's got any questions. I know we've had one submitted before, so we'll come to that in a moment. I guess I just wanted to just conclude really what we've talked about today. So initially, we've spoken about what the allowances are and things that you need to be aware of around the nil rate band, the residence nil rate band, and some of the caveats, especially with that, caveats is the wrong word, little special rules around that residence nil rate band that you need to be aware of, because we quite often get this kind of broad sweeping thing of, a couple has £1 million. And we very, very often even here when we're doing IHT calculations before meetings, we're putting our checks and balances in place. So do we definitely have children, in this family? Is there a linear descendant, so that we're doing that calculation right? There's no longer just a sort of sweeping generalization of what the allowances are. So really important to understand that. Then Jamie's spoken a little bit about as well some of that legal stuff that we think is so important, because we can talk about inheritance tax planning, but first you've really got to get those legal things in place. Get your wills up to date, make sure you've thought about whether you're giving to charity, make sure that people know also what you would want to happen if you are still here but incapable of making decisions, and also one thing I should probably mention is if you are acting as an attorney for someone, it's still possible to make good decisions around inheritance tax. If that's an issue, we can invest as authorize investments as attorneys as well to ensure that we're making good decisions for that person's estate. So a couple of things in that regard as well to think about. Then, of course, going through our process of, do you want to gift money? Do you want to retain access to money? Do you want to think about the complexities of trusts, or is maybe something like business relief more suitable for your scenario? So, those are the kind of things that, we'd welcome discussions with you as clients when talking about inheritance tax. And we do tend to see those things filter through in the years when we start really thinking about what's going to happen when we're no longer here. Let's face it, we start to think about those things a lot more when we're not so focused on retirement and we're now in retirement thinking about the next step. So that's typically when those conversations tend to happen with you as clients, but we welcome those conversations at any point. So Jamie, I know we had one question submitted already, so do you want to ask that, and I'll just have a look in the chat and check whether there's anything else?
Yeah, so I can just see that Peter's asked a question in the chat, so you can come to that one in a second, Gretchen. But
sure, yeah.
In fairness of time order, I know that that Brian has asked a question in advance of this, so this one's for you, Siobhan. With a potential change of government on the horizon, what does time take a view as to what a change of government may think about inheritance tax generally and how that might affect the qualifying status of business relief investments?
Yeah, it's a question we're often asked, and it's very difficult without a crystal ball, obviously, to speculate as to how things might change. What we know about IHT is that it's at its highest level ever in terms of the tax take. So in 2021-2022, the IHT tax take, HMRC stats tell us, was 6.1 billion, and it increased by £1 billion in the year 2022-23. So £1 billion more has been raised in inheritance tax in the last year. So it's certainly on the rise, because generally speaking, people's estates are worth more. The benefit of just property appreciation, you'll be alarmed to hear that over the last 40 years, property prices have increased by 973%. Now, I know we're in a sort of a slightly dampened environment at the moment in terms of people's outlook on property, but nevertheless, that alone, along with asset appreciation within portfolios, is continuing to give people a problem. Having said that, in terms of any changes to IHT, it's still an absolutely tiny proportion of the overall tax take. So I think the numbers go that of everybody who submitted IHT returns in the last year, only 3.7% actually resulted in an IHT charge. And so it is a tiny proportion of what the overall is. Corporation tax is, the majority, along with NICs. So even a change to inheritance tax, be that an increase or some other changes, is not likely to generate a huge amount of impact for the government. As for business relief, again, it's one of those things that the Office of Tax Simplification has opined on the matter on many occasions. I think the most recent was in 2019, and there was no speculation at all that anything would become any worse than what it was right now. And because of the way in which many business relief investors, or providers, if you like, invest, we are looking at private enterprise, we're looking at investing in UK small companies, we're looking at improving the clean energy mix in the UK by investing in new technologies and clean energy. So unfortunately, the government don't have the resources to do that. So I think things like business relief are here, at least for the foreseeable. And if there were to be any changes, it's always our opinion that those would be prospective changes rather than retrospective. Those are, not certainties, but certainly how we tend to see it.
Yeah. Yeah, certainly. I mean, we can't, the amount of times that my clients must have heard me say, I don't have a crystal ball, we don't, but I agree with you. I think that we've got to remember the purpose specifically of business relief is to encourage family businesses, smaller businesses, and innovative businesses to thrive.
Correct.
It happens to bring along this inheritance tax potential saving now that we can apply ourselves in, invest in asset-based, and as you say, in the AIM market, for opportunities for our clients. But ultimately, the relief is there to help family-owned businesses, etc. So I think it's unlikely to change in that regard. So the other question that we had from Peter, we have done another one as well. I'll let Jamie take the next one. But the other one from Peter was about pension funds, and if pension funds are liable to inheritance tax. The pension rules changed a number of years ago, which altered the way in which pensions were dealt with when it comes to your estate. They are actually outside your estate for inheritance tax, so you can leave your pension fund, especially, so let's clarify, personal pension funds, defined contribution funds are able to leave those to the next generation or beneficiary of your choice without it being classed as part of your estate. It will get taxed, it's going to get taxed instead on the beneficiary when they choose to draw it, depending on their tax rate, their marginal rate at that point. So an example might be that a father leaves his daughter his pension fund. She might be working and a higher rate taxpayer at that point. She doesn't have to do anything with that pension. It can become part of her future pension fund, and then her be able to take that at a point where maybe her tax rate is lower in retirement, able to do tax planning of her own in that regard. And equally, if she wanted to then pass that fund on again, it can go down multiple generations, remaining invested in a tax-free environment. So certainly those rules are of big benefit if that's an opportunity that you have to leave that fund. But ultimately, when it's drawn at some point, as soon as it's drawn out of that pension wrapper and that protective pot that it's in, that's then going to be taxed as income tax to income tax. Defined benefit schemes are not able to be transferred in the same way. So anyone with a defined benefit scheme knows that, you know, other than maybe providing your spouse with a potential benefit if something happens when you die, when you pass away, after that, after your spouse has also passed away, that pot is extinguished and no longer available. So that's my answer on the pension question. Jamie?
Yeah, great. So just see there, Peter said, okay, thanks. So I think that's covered it off. Pretty complete answer there. So the other question from Barmini was around whether you need to go through a legal advisor or a solicitor to set up powers of attorney. So the short answer is no, you don't. So if it's something that you feel comfortable and confident enough doing yourself, then you can do it through the gov.uk portal. So if you type in, create powers of attorney on Google or whatever search engine you use, you'll find that. But equally, Barmini, I'll send you a follow-up note, and if you want to look to put those in place, I can help you with that.
Yeah, I might just add, because I got other question from someone in a meeting the other day as well, that because they'd started it via the Gov UK website and then got on a bit thrown because it asks you for quite a lot of information. So just as a tip, think about who it is that you're going to ask to be your attorneys. Make sure you've got their name, address, date of birth, and everything that you think you might need. So it's basically name, address, date of birth. And that you know those things, because they won't, you can't move on a screen until you've filled in some of those things. So I think that's what happened with my client, is it started to ask information that he hadn't gathered, and then he started to sort of think, oh, I don't know if this is that easy. I think it is, provided you've got all that information. And a power of attorney as well, they can be very basic, so you don't have to put specific guidance in. You can trust that your attorneys are going to make the right decisions for you. So you can just nominate the attorneys and go through, and then at the end of the form, you'll get an option to print it out so that everyone, including the attorneys, can sign that form and then submit it to the Office of Public Guardian to get it registered. But there are also boxes that you can leave specific instructions. So if you have specific health instructions that you'd like to leave on that one, you can do that. If you had something specific in the general, the finance and property LPA, you can also put in specific things. So if you wanted to ensure something specific happened with a property, if you were incapable of making decisions like a rental property, for example, and you wanted it to be sold by your attorney as soon as you're incapable of making those decisions anymore, or on the reverse, that you wanted to keep it, I think certain things like that can be detailed in it. So quite important to think about what your actual instructions for those attorneys might also be if you're going to give specifics. But as Jamie said, if you want any guidance from us, then very happy to give you that as well as you go along. So I think that's all the questions. Thank you so much, Jamie, for organising it, because he's done all the organisation in the background, and I do really appreciate that. Effort and time of the team to get these things together. So thank you, and Siobhan, for joining us. It's been great, and always good to have a third party's perspective, and introduce the concept of business relief to more people is great. So thank you very much.
Pleasure. Thank you.
And thank you everyone for joining us today. I'll end the webinar now, and we'll make sure the recording's up. If you missed the start of it, you'll be able to go back and see that, and obviously for the people who are listening back. So thank you very much. Bye everyone.
Bye-bye.
Bye-bye.